Good morning, everybody. It is Monday, November 10th. I'm Kirk Spano, and this is Investing 2020s. We are going to talk about some of our stocks today, but really we're going to go through some of the technical charting that I do because I have been in the process of really aligning all of my services. As many of you know, I own an investment firm, Blue Mound Asset Management. Also run the investing group on Seeking Alpha, Margin of Safety Investing, as well as owning fundamentaltrends.com, which you are looking at right here. And then I have a Substack, which is just growth stocks and what I call a skinny service. It's not all-inclusive, but for people who just want growth-oriented investments, it's a cheap little service for people who want to maybe buy growth stocks to augment a 401k portfolio or something along those lines. Margin of safety investing and fundamental trends are essentially the same. I have been moving in that direction for a few months now. One, to make my life easier, and two, to really focus on the things that I do best. So that process will be completed by the end of the year. And going forward, fundamental trends and Seeking Alpha's margin of safety investing that I run will essentially be the same service. The difference will be the chat rooms. Chat room platforms are different. Fundamental Trends is more of a forum setup, and Margin of Safety is a lot more chatty, a lot more threaded. So other than that, the two services will essentially be the same. If you like the Seeking Alpha platform, then use it. If you prefer Fundamental Trends, then use it. The difference in the content will be extremely negligible. So anything at one will be at the other. As far as what's going on in the markets right now, you probably saw a post from me in the chat rooms or on X where I said on Friday morning that there'd probably be a turnaround in the market starting after lunch on Friday. Now, when I say something like that, I'm not speculating from the standpoint of I'm just guessing. I'm speculating from the standpoint of I've seen it before. And one of the things that has caused the market to get a little bit beat up lately, a little bit choppy, has been the fact that the trader group, which we know is twice as big as it used to be, right? Pre-COVID to post-COVID, there's twice as many people trading. That is a lot of money at the margins that moves quickly and with leverage. And they were using the double short ETFs. Well, going into the weekend, I'd say about 9 o'clock on Friday morning after the market started out down, I said that it would end up potentially up, or at least around lunchtime would reverse. Most people don't want to hold a short ETF into the weekend. You never know when somebody in the White House is going to say, hey, we have a solution for something or a big deal, or that the shutdown is about over. Well, we knew that there's a lot of pressure growing among politicians to end the shutdown. And sure enough, this morning they announced that they're most of the way to a deal to end the shutdown. And we'll see exactly how that goes. However, I would say that there's probably a deal. If it's not by the end of this week, my guess would be Monday. And, I'm looking at flying out of town on Monday. So happy air traffic controllers are good news for me. So I think that is something that would probably create a bit of a bounce in the market. We know, this is just quantitatively, we know that when the government reopens, then they will reliquify their balance sheets at the Treasury and start paying out money again, in particular salaries. And that slight downtick in the economy because of the shutdown will reverse. And that's into the seasonal upside of November, December, January, and early February usually. So I said in the chat room on Friday as well, probably want to play the bounce. So if you play bounces, I think you're probably going to get that last puff on the cigar in this bull market over the next 2-3 months. For me, I'm selling mostly cash secured puts because in 2 or 3 months they're expired, and that would play right into what I think will be the top in this bull market. So I do think that we're going to retest the all-time highs. That's 3-5% higher, whatever it is. It might even go through by a few percent, 3-4-5%. We'll see. Now, remember, a normal year is a total gain of 10 to 12%. Been closer to 15 since we got into the QE age. So if you start to think that 30 and 40 and 50% moves are normal, then you're getting sucked in. And that's not normal. If you can average 15% a year, you're going to triple your money, right? Not just double. You'll double your money every 5 years, but you'll triple your money about every 8 years. So think about how well you would be doing if you just doubled your money every 5 years or triple it every roughly 8. I mean, that's a pretty good deal. That crushes inflation, really is real wealth accumulation. Now, if your stock picks are pretty good, and if your asset allocation is above average, and you learn how to sell cash secured puts and covered calls using the real simple technical indicators, which I'm going to cover today, maybe you can average 20 or 25. I've averaged low 20s, pushing 25 in my career. It's been a combination of option premium, and I tend to find one or two big winners most years. That's all it takes. You don't have to be hyperactive. You don't have to trade a lot. I heard some kid talk about day trading the other day. I mean, it was kind of funny to me. My son, whose account I manage, and his account's up, because he's got a 5-stock portfolio like me. His account, he showed his friend how much his account was up, and he basically doubled his money in 18 months. And his friend goes, "Oh, what does your dad do? Does he day trade?" And my son said, "No. He sends me a text every couple of months so he can log into the account and he makes a trade." So every couple of months, he said, "How does he make any money doing that?" And again, my son was like, "I don't know. He just knows what he's investing in." And I've told you that, you probably don't want the super focused portfolio that I have, because you can lose a lot of money, right? If you have 5 mediocre or bad picks, you're in trouble. Last year, we had Rocket Lab and ASTS, or over the last year, and that carried the day, even though Ametis hasn't made any money. I just want to cover some things today so that you can think through what's appropriate for you. I want you to, and if you haven't done this already, I want you to learn to respect the technical indicators, in particular momentum. And I'm going to show you something that I use for inflection points. It's something that I've been using loosely for a few years. I had been doing it manually myself. As I have told you, the algorithm builders are so good, right? The people who you can pay a few $100 a year to build your algorithms and your trading indicators for you are so good. Your job is just to understand it, not to build it, for 90% plus of you. And that includes me. I used to program in Python my own algorithms, and I was pretty good at it. Right? I was a quant before being a quant was cool. I remember getting recruiting calls and emails in 2004. "Hey, can you do quantitative analysis?" And I was like, "Yeah, we want to come out to Boston and work, or come out to New York and work." And I had little kids. And I said, no, but I still did it. And if you take a look at some of the algorithmic systems that are out there, you'll find a bunch that are pretty good. The one that I'm using is called Lux Algo, because it overlays on the trading view. And I'm going to show you the indicator that I like the best. And they have dozens. But the one that I'm going to show you that's at the bottom of my charts now, I really love it. It incorporates multiple factors all into one indicator that I don't have to monkey with anymore. They monkey with it for me for a few $100 a year. So I'm going to show you that. Now, as far as my stock picking goes, I synthesized it for you in this month's Punch Card Stocks article. And I have the 4-step process, but at a granular level, when you get down to the actual stock picking, these are the traits that you want to see with your companies. You want to see that they're in an industry with some barriers to entry, high switching costs away, network effects, some value from their intangible assets like patents, and then government policy is at a minimum not against them, preferably in their favor, but not against them. Those first 4, as I mentioned last week or the week before, are from some pretty pretty successful investors. It's how they identified software companies 20, 25 years ago as, these are the companies that are going to make a bunch of money, and they did. So right now in the AI ascendancy, we are going to find companies that have some barriers to entry, high switching away costs, the benefit of network effects, right? As the network grows, it even gets stronger, and value of intangible assets, ways that they handle AI or use AI or control AI or protect from AI or amplify AI. And then sometimes government policy will be in their favor, such as with carbon credits or biofuel tax credits, things like that. That is my focus. One of the things that I have gravitated more and more to, and remember, I was a broker and everybody wanted to pitch oil and hard assets and age of scarcity, things like that. And what I have learned over time, and I wish I had known more about this 20 years ago, but really since I'd say 2015, it's just pounded me in the head. What happened in 2015? That's when the Saudis decided to flood the market with oil. And it was a reminder that certain markets are not constrained by supply naturally, but there's choke points. And there are people or entities that control the choke points. So while people will talk about a shortage of energy, there isn't really, but we control the public's access to the energy by allowing cartels to control oil and gas, by letting special interests create a narrative that gets to the politicians and they change government policy. As I've told you, I think solar is a no-brainer. It's cheap, it's efficient. The batteries are getting super cheap and efficient. Now they don't start fires. I think Elon Musk is right about solar, that it could become 80% of the energy mix at some point. I think for sure it's on its way to about half. And I think that that's by the 2030s. So as our demand for energy goes up because of AI data centers and just a broader electrification of the economy because climate change is real and we have to do something about it, I think that's a big opportunity. And the switching away effects or costs are pretty high, right? Once you put solar on your roof, you're using solar. And by you, that's mostly companies. If you build a new house, you might pitch it so that it can use solar. But really, the utilities are moving towards solar. And if you have a big building with a rooftop, why would you not put solar on the top at this point? A lot of managers, specifically, I would say small business managers or owners, they don't put solar up because they look at it as a cost. And because they're operating close to the margin, and a lot of times they're sucking money out for themselves, they don't want to invest in 5 years out, right? It's just, how much can I pull out now? And I think that that's about to change because a lot of those managers and business owners are baby boomers and they're on their glide path out. As Xers buy more businesses, but in particular as millennials buy more businesses or start businesses, they will look at that 5 to 10 year outlook and say, okay, does it make sense for me to put solar on the roof? I do most of my business during the day. And does it make sense for me to have battery power? At what level does it make sense for me to have battery power? Do I want power for 1 day or 3 days or a week? How much battery storage should I have? All those things are coming. So when you look into the future, which is what you're doing as an investor, you have to think about what does technology change and what are the second and third level impacts. So while everybody likes to invest in the company that's creating AI right now, if you take a look back at the internet, VeriSign isn't the biggest company in the world, right? It's not the companies that that control the URLs. It's freaking Microsoft and Amazon and Google, the companies that use the internet. And they've obviously expanded into many other things, but between software and using the internet, they become giants. They will remain giants because they are vital to edge computing, which is something that I told you over 5 years ago about after I came back from the computer electronics show. Remember the CEO of Samsung said, AI plus IoT and 5G is the perfect marriage. And we're finally seeing that. It took over 5 years, and now we are right at the cusp of that explosion where, if you think about it like network marketing, it starts with you, and then you get your 5 friends to sell your product, and then they all get 5 friends. But when does that organization become really big? That next one. and then that next one. And that's about where we're at right now. The mass adoption of AI just began, but over the next 3, 4, 5 years, it'll be that fast. And remember, I've told you about the difference between thinking something will happen in 2 years versus 10 years. Usually people gamble on the investment in 2 years, but then it takes 10 years to play out. And that's why you get the Gartner hype cycle, spike up, then a come down, and then gradual adoption, that wavy look. This one's going to be faster. It's not going to be 10 years. It's going to be about 5. By the end of this century, by the end of this decade, I expect that you will see some medical breakthroughs that will blow your mind. I've been paying a lot of attention to that. It was interesting to me that I've been telling you about Pfizer, theoretically about what should happen over the next several years. And Dr. Michael Burry of Big Short fame was very long on Pfizer all of a sudden. Pfizer. Why would I invest in boring Pfizer at $25 a share? Yeah, they pay out a big dividend. But what do you think AI is going to do with their mountains and mountains of patents and data and their clinical research ability, right? You can say, well, I don't see it yet. Or you can say, I know it's got to happen. I just don't know what year it'll be. Some people say, well, I'm just going to wait a while. That's 6% dividend or whatever it is, not juicy enough for them while they wait for an announcement that, hey, we got the next big thing. Pfizer is going to be one of those companies that has the next big thing, and they're cheap right now. And that's the kicker. People who were buying Eli Lilly at the top because, oh, look, it went up for 2 years, they're just bad investors. When bad investors say, sell me something that just went up 400%, generally you should sell it to them, especially if it was big and got bigger. If it's small and got big, you have to ask the question, how much bigger? Like AST Space Mobile, which we bought at below $5 a share, right? We started at 8 and then at 6 and then at 4. And there were people, when it went from 8 to 4, were like, I sold it. I just took my tax break. And I said, that's a pretty bad time to sell. I'll buy it back in, a month, maybe. Most of them didn't. They probably didn't buy it until it was 17 again, or 15 or 20. I cannot tell you how many people asked me about AST Space Mobile when it cracked 50. And I said, I don't know. I mean, I maybe buy a pullback. And then, they were like, how did you know it was going to pull back to 40? And I'm going to show you that in a minute. I didn't know it would go all the way to 30, whatever it went to. But I sold a bunch of cash secured puts down there. And when it got to 75 and 100, I was telling you, take your profits. Now it's back down to 70. Looks like it's going to head into the 50s. And I've told you with regard to companies like that, don't think about the dollar value of the stock. Think about the market cap. If I think that AST Space Mobile is $100 billion to $200 billion company in the future, $50 billion being the absolute minimum, but I think I'm over that now. That's what I said in the past, but I think $100 billion to $200 billion is where AST Space Mobile is headed. Currently, it's trading at $25 billion. You could conceivably buy it now and just wait. I'm a greedy dude, so I'm trying to get it even cheaper. If I can get it at $20 billion or $17 billion, that's what I want. Pfizer, $130-something billion company. Well, how much bigger can it get? Well, there's a car company that's worth $1 trillion that don't make no money with a far smaller total addressable market, except for some of the imaginary things they talk about. Do you really think there can't be a $500 billion or $1 trillion dollar-company that keeps you healthier? I do. I think Pfizer getting to be a $500 billion company is probably about where it's headed. Maybe it can get to $1 trillion even. Take a look at some of the pharma companies and biotechs that are bigger. And ask yourself a question. If we start finding cures or much, much better treatments for all the things that kill us, what is that worth, right? What is that worth? I think it's worth a lot. And if you've been paying attention, there are a lot of people all over the live much longer, healthier thing, right? It's like a movement. So think about these things in the context of total addressable market. Health is a gigantic total addressable market. Energy is a gigantic total addressable market. Technology, industry, gigantic total addressable markets. And when you can buy them at a discount at a cycle bottom price, probably a good time to do it. So let's take a look at some of these companies. These are all stocks that are on the very short list and on the punch card stock list. So the very short list, it's about 300 companies that I track using a spreadsheet. And I use a couple of different quantitative sources as well as all the brokerage research. And I have something that aggregates it all. And I try to figure out what is the 5-year price potential. So when you take a look at the very short list, that is from the range of quantitative analysis that's out there up to 26 different models and all the analyst estimates. And so there's a range from the most bearish quant models and analyst estimates to the most bullish and everything in between. And my job isn't to sit there and do a model, because what's the point? My job is to figure out which model makes the most sense for the investment I'm looking at. And where in that range do I think something is going? There's very few large caps where we don't really know everything, right? Most large caps, you know most of the stuff. Pretty efficient market, information is out there. And yet, people still don't think that executives skim and that it's corrupt. I do. So I think I have an edge because I'm willing to accept that as mostly a reality. You know, we talked about that sort of thing with Warner Brothers and Zaslav for years. So in the large caps, it's hard to find a company like Pfizer that you think the market is just completely overlooking the impact of AI on their operation. I don't think the market will overlook it very long. And they have a bunch of pipeline candidates coming out soon. And by the way, it looks like they're going to end up with a GLP-1 technology and weight loss technology here soon that they're just going to buy. And if you take a look at Eli Lilly, you know how much that moved the needle. When you think about all these things that we want in life to be important and how we want to solve problems and fix things and live better, it actually helps you be a better investor, right? Where is there money to be made? Maybe there's money, Pfizer, Amgen, littler companies, maybe there's money to be made in a facial cream that somehow helps your skin regenerate or gets rid of the zombie skin. I don't even know the name of the thing that does that right now that's new. But if it works, hey, it's big money. And McConaughey uses it. So, there's your spokesman. I forget what it's called, OneSkin or something. So you take a look at the world and you say, okay, what's valuable, what's not valuable? And Prologis, which is the biggest industrial real estate REIT out there, it's been chopping along for a number of years. And it's a favorite of the boomers who are like, I like my dividend. But really, there's two things going on here. First is that their U.S. operations are pretty much capped. Not much they can do in the U.S. anymore because they're too big. So in the U.S., I'd rather have Stag Industrial because they're smaller and can grow more. But Prologis has been expanding around the world. And AI is helping them with their warehouses and floor space, right? The machinery, the machine learning, the robots. So two things that I don't think are factored into the future price of Prologis is the impact of AI, machine learning, and robots, and the fact that they're expanding overseas. And we might be entering a period where the rest of the world does better than the U.S. for a while. Oh, Kirk, how can that be? Right? I'm a big U.S. bull. I am. Well, there's a lot of the world that's got a lot of catching up to do, and they're pretty motivated to catch up now, right? I think that we have woken a lot of sleeping giants lately. I could be wrong, but probably not. I think there's probably pretty good international growth. I think China, India are the obvious ones. But I think there's select places in Europe that are going to do very well. And how do you invest in them, given that a lot of those companies are, never going to grow? Got to find the ones that will. You have to find the private equity firms that are going to make those right investments. You have to find companies like Prologis that can ride along with the trend. Now, is Prologis going to double or triple or quadruple for you? Probably not quadruple. It might double off a bottom. And then, by the way, you have that dividend on top. So I am looking to buy the dip on Prologis. I think a price in the 90s is probably where you see it at some point as the credit crisis that we know is coming. Right? It's not speculation that there's a credit crisis coming. We know there's a credit crisis coming. What we don't know is how fast they're going to print their way out of it. And what a lot of people don't think about is a bigger crash better for certain people who might have big checkbooks and controls on the levers of power? Think about it. Think about if you're in the sphere of influence of President Trump, how much of a rebound and how fast do you want? How big of a dip do you want before you act on printing money? You might want to wait a while. You might want to wait for prices to get really low because you'll just be sitting there buying. And then you print the money and get your inflation on your asset. Is that conspiracy theory? Is that cynical? I think it's probably close to realistic. So either things get bad for a while or they get really bad for a while longer. And then they print the money. You can't jump over the crisis. The crisis has to happen before they print the money. If they just print money for the sake of printing money, which is not what anybody's talking about in the administration, in fact, they talk the other direction, that would be weird to me. President Trump's pretty much already said he's not running again. And I think the rest of that family is not viable. And he doesn't give a shit about J.D. Vance or whatever his name is this year. So with Prologis, you see that the channel here would get it down to around 90. I want you to take a look at this Lux Algo. This is the oscillator rating that I use. And I've used a number of these. I really like this one. The red dots are pay attention. Probably have a change in trend coming. How accurate are they? Well, when you combine them with these other signals, which are also Lux Algo, you see that they are pretty indicative of changes in direction. Now, this one's been real choppy, so the signals are a little bit skewed, but still pretty good. Buy signal up. This one is Wyckoff. Here's another Lux Algo signal. And now, buy signal already happened. Don't have a sell signal yet, but we have a pay attention signal. Right there, look, that red dot right at the top there. Let's take a look at this one. This one signaled a pause. That one was right at the top. That one was right at the top. That one kind of hit a jitterbug, right? They're pretty good. Within a standard deviation, they're pretty good. So when you take a look at different signals, the RSI on the weekly is the easiest one to look at. When you get overbought on the weekly, typically you'll either get a pause or a correction. And a pause is just as likely as a correction. Depends on, is it the second or third time that it's been overbought? Usually the second or third time it gets overbought is usually when it really starts to correct. First time, often it's just a pause in the price appreciation. Here we have a second one, right? One peak, two peaks. So maybe it comes back down here. But next year, if we have some credit issues, which I think are incredibly likely, like way over 60% likely, closer to 90% likely, then you get that ABC down, 1, 2, 3, whatever you want to call it. And if I'm right that maybe they're slow on getting the QE out, then maybe another leg down. Wouldn't you love to have Prologis at a 2020 price down in here? Don't be impatient and don't have FOMO. Let prices come to you because every few years they really do. I'm not just talking about the little dips during a 2 or 3 year bull market. We know that there's a pretty big correction about every 4 years. And in the second term of presidencies, there's often an extra one. There was for George W. Bush. That one was a doozy. And I don't know if we should be thinking about the Trump presidency as a second term, right? Because it's not back to back. But I'm thinking of it that way. I think Biden and COVID were the anomaly. I'm thinking of this as a second term for Trump, almost as if it was consecutive. And I think that we can get a double dip here. I think we get a correction, a rally, and another correction over the next 3 years. And maybe if they print enough money, they push the following correction, the second debt correction. How many of you watch Foundation or have read the books? I read the books and then I've been watching the show lately. Read the books when I was a teenager. Isaac Asimov. 3 crises. The first U.S. debt crisis was the financial crisis. The second U.S. debt crisis will be refinancing this debt over the next 2-3 years, $30 trillion by the end of the Trump presidency. And then the third debt crisis will be funding the baby boomer retirement. The first debt crisis was 2008. People almost forget about it, 17 years ago. I still remember sitting there watching it on TV as it unfolded. The next 2 debt crises might be within 5 years of each other, or 6 or 7 or 8, something like that. Cliff Asness was on Bloomberg today, and he said, look, maybe we don't get horrible corrections. Maybe we just get a really disappointing decade. From these multiples, and he talked about the Schiller price multiple, maybe that's it. I think the S&P 500 investors are going to lag because I think that so many of the companies in the S&P 500 are just married to old industries that are in permanent slow decline. And there's not much that AI can do to help them. It'll offset the slow decline, but it's not going to turn them into growth monsters. So you have to think about these things. So let's look at an old line company, Berkshire Hathaway. I bought it recently at $4.75, just a nibble. Just a nibble. There's no real signals. Here's a red one, almost at the top. It was a little bit late in signaling. But here's a company sitting on $375 billion of cash. The privately held companies in there are probably worth $500 billion. And then you have the public equity portfolio probably worth another $500 billion. Give or take $100 billion. You know, what's $100 billion here or there? If you just took the cash and short-term investments off of the Berkshire Hathaway balance sheet, it would be something like the 50th biggest company in the world. Think that through. Their cash balance is about as big as the 50th biggest company in the world. What can they do with that cash if the stock market corrects? Two things. Go out and buy stuff, or buy your own shares back. A price somewhere in the lower 400s, them buying their shares back becomes kind of a no-brainer because the rest of the company is worth way more than that. There's a couple of calculators out there for the intrinsic value of Berkshire Hathaway, and they'll give you numbers depending on discount rates and estimates between lower 400s and 600s. And that doesn't include the cash. So if they get a little correction here, Berkshire Hathaway, for those of you who want a conservative core holding, I'm telling you, I think this is the best conservative core holding in the world. But there's no dividends. So what? So what? If you really need the money, sell a share here and there. Most of you don't. And if you can afford 100 shares, well, there you go. Now you can sell a covered call or cash secured put, I guess. Maybe sell a cash secured put to get that one share. I don't know. You get those 100 shares. But a price around 400, the lower 400s. Elliott Wave is saying the same thing. And look how shallow these are, right? The quantitative analysis that's built into the algorithms in here that I use I think are pretty good. So I don't have to do it myself. It shows me a range, right? So I have Elliott Wave on here. I have something called all chart patterns. It's not really showing there's not an alternative chart pattern that the algorithm is picking up. A different algorithm is picking up. The linear regression, right? That's just, I have that set up. This is the trend. The super algo gives some buy signals and sell signals. You know, kind of worst case scenario is 367 they're seeing. Wyckoff Springs hasn't had an indicator in quite a while. Institutional fair value gap. I like this one. This just feels like a magnet, right? It's what it is. It's where the institutions start to buy or sell sometimes. This is a big zone of institutional interest. So if it goes below here, probably is a bargain. Goes above here, probably not a lot of institutional buyers pulling it up. You got to rely on the retail guys, and they don't always have a lot of juice, right? They're only 20% of the market. Weekly RSI, if it dips down in here, probably becomes a buy. You see how it very rarely gets all the way oversold? So you're looking for something in here, not down here. Then the Lux Algo, right? Kind of a sell signal. So what you want is not necessarily an actual buy signal, but you just get one of the pay attention dots. That's what I call them, the pay attention dots. You get a pay attention dot in here somewhere, right? Now, so you say, I know enough about Berkshire Hathaway that I can probably start buying into it. So I took that nibble at 475 just because I wanted to have it in the accounts, but I really don't have much. It's a little less than 1%. Gets down in here. All my conservative accounts are getting a slug of this, probably a double position. AMD, big waves. 1, 2, 3, 4, 5. Ha, ha, ha. So you probably get a correction here, maybe towards the bottom of the channel. Elliott Wave is saying down in here somewhere. Fair value gap is pulling it down. Probably get the overshoot. And if you're in love with AMD, you can buy it. Now, I won't buy it inside this whole... I won't buy AMD anywhere in here. Why? Because I could probably just buy QQQ because there's probably a correlated move with all the other QQQ big stocks. But if AMD shoots all the way down here, or if a Microsoft would break this kind of trend, right? We could take a look at Microsoft. I bet it looks kind of the same, right? Kind of the same, right? Microsoft gets all the way down here, I'm probably buying it. In this range, that's just not worth it to me to buy Microsoft. I buy QQQ if I want. Down here, maybe it's cheap. Blackstone. I am a believer in private equity. I don't think it's something that you should buy in your 401k because I think you're just guessing. But I study their portfolio holdings. This ending pattern, if it gets down in here, maybe I buy it. It's coming back down to where I thought about it last time. If it shoots through, if it gets down here in the lower 100s, or if it gets all the way back into the 80s or 90s again, right? The 2022 lows, which I have told you that I think is likely to happen again. I think we challenge these lows again. Does it get all the way to the bottom? I don't know, but in here somewhere. And I think a lot of companies get there. The winners, I think, round trip or close. So if you get it down here, it's cheap, right? Down in here, it's kind of a no-brainer. And then you scale in, boom, boom, boom. Or you buy a little and sell a cash secured put. And when it starts going up, you buy it again. Permian Resources. I think this little pay attention dot right there, you see it down there? Pay attention dot. I think, right? It was right on that bottom. It's in this institutional buying area. Now, if we get a recession or a recession scare, can it come down here in the single digits again? It can. And here's what I will tell you. If you think about what happened in 2020, the energy stocks really ripped off of that lifetime bottom. Not just generational, but multi-generational bottom down here. I don't think we'll ever get down here again. However, about halfway on the retrace, right? So from 1 to 16, that's a $15, $16 gain. Take half of that. A correction down into upper single digits is very possible. I think that this one's very unlikely. We'd have to have a COVID-like crash. But something in here, holy cow. You just want to buy it all because they can't lose money at that point. Not this company. Look at their balance sheet. Look at their production. Look at the production that never got to market that suddenly gets to market because of the pipelines. So this one's chopping along right now, biding time. I don't think this screams for a big correction, but it could happen. And I think that in the next several years, because we've kind of shit all over clean energy in the last year, I think it's inevitable that gas and oil prices go up for a while. Timing that is difficult, but we know that Saudi Arabia needs a lot of money between now and the end of the decade. So we'll see. But again, if you're a dividend investor and doubling your money plus a dividend is worth your while, then buying the dips on Permian Resources is probably a pretty good deal. I am going to, and I just applied, so I don't have it yet. We're trying to get a discount code for you for Lux Algo if you want to use it. Or you can just look at mine and wait for me to tell you, and that's fine. I don't know that you really have to have Lux Algo. I was using the BASS indicator before, bias and sentiment strength, and it's pretty similar. I just like the dots. Pretty similar, right? When you get a big oversold red and it starts to flatten, usually a buy signal. So you can use that too. I don't anymore because, right, they all just kind of look the same. On the very short lists, Teresa has put in the bottom fishing prices on almost everything now. Generally, those are based on monthly charts. So those bottom fishing prices are based on long-term trends. That's probably about as bad as it can get if the world doesn't end. So click on some of her charts and take a look at them from the very short list. Now, when you do that, there is a cookie embedded so that if you decide to buy TradingView and you don't already have it, right? If you don't already have TradingView, she'll get a little commission. And I'd appreciate that. And I'm sure she would too. So consider getting TradingView just so you can have the ability to do some charting and play with the free stuff, right? You don't need the pro subscription that I have. That second one up, Past Essentials, I think it's called Premium. No, Pro. It must be called Pro. So I have the highest one up. You want the one in the middle. And read Getting Started in Technical Trading. Again, you don't have to be a chartist. You don't have to even draw any of your own stuff. But you need to understand what I'm showing you and what the market is telling you. This is the market telling you what lots and lots of people think. It's a way to be efficient. It's a way to follow a trend when it's active. It's a way to find pivots when the market gets exhausted from selling or gets exhausted from buying. So if the market is getting exhausted from buying, what should you do? What two things do you do when the market is getting tired of buying whatever it is? Two things. What are those two things? Do you all have the answer? You're just keeping it to yourself? If the market is exhausted from buying a stock, what do? Correct. Sandy got it. Sell or sell calls, or a little bit of both. There's no absolutes. Scale in, scale out, small, slow, wide price points. If it gets exhausted from selling at the bottom, and you think that the company is going to exist in a few years, you don't think it's going out of business, what do? You buy it. And technical analysis for following a trend is much different than technical analysis from finding a pivot. In a trend like this, what should you have done for 3-4 years? BTD, buy the dips, right? All the way up, you could have just bought the dips, and now it's choppy. So you're trying to figure out, where is the bottom going to be? Was it already here? Maybe. I actually kind of think probably. Are we about to enter a new upcycle? We can't say that yet. It wouldn't be unusual for this to get down in here or here. And that's the start of the new cycle. But here you got 1, 2, 3. That's a pretty standard correction. 1, 2, 3, maybe 4, 5. Based on what I know about this company, I think it's going to end up getting sold or merged into something else when it's in the upper 20s, pushing 30. It's a double or more plus a dividend. Again, this is not for your super growthy investors, right? If you just want nothing but growth, not something you buy. But if you want something to kind of balance out your portfolio that has income and not much downside, right? I mean, it can trade down, but it would come back. There's really no risk of permanent loss here unless they really do something bad. So decide what you need in your portfolio. What type of investor are you? Are you an intelligent investor who absolutely is doing everything you can to avoid losses? Or are you an enterprising investor and you take a little bit more risk and you focus a little bit more on growth? That's how I understand those things. See, that's a shorthand, super shorthand. All right, I'm going to let you go. I am working on a stocks and options of the week article this afternoon. I leave home at about 5:15 to go to my yoga and then weightlifting. And yeah, we'll go from there. I have zero concerns about Ametis. All right, everybody, have a fantastic day.